Every year, millions of people decide, this is the year I'll start investing. But within a few months, many give up, not because investing is impossible, but because they fall into the same 3 traps. Today, we'll break down these mistakes, see why they're so common, and most importantly, learn how you can avoid them and build wealth with confidence. By the end, you'll know exactly how to start strong, and there's a bonus tip at the end that could save you years of stress. Mistake 1. Chasing quick gains. One of the most dangerous temptations is the hunt for instant profits. Think back to the meme stock mania of 2021 or the crypto rallies of 2024. New investors saw people bragging about overnight riches on social media. That fear of missing out, FOMO, made thousands jump in without understanding what they were buying. Here's the truth. By the time you hear about the next big thing, the early profits are usually gone. Prices spike fastest when excitement is at its peak and often fall right after. Instead of chasing hype, start with clear goals. Are you investing for retirement, a home deposit, or long-term freedom? Learn the basics of the asset. How does the company earn, or what problem does the crypto solve? Diversify. Don't let one shiny object dominate your portfolio. A quick story. A friend of mine bought a trending token after seeing it on TikTok. Within 2 weeks, it lost 70%. Had he split that money between a simple index fund and a solid company stock, he'd have been up, not down. The lesson? Wealth grows steadily, not overnight. Mistake 2. Ignoring risk and skipping the emergency fund. Imagine this. You've invested all your savings and then your car breaks down or you lose a job. Without cash reserves, you're forced to sell investments at the worst possible time. Before you invest, build an emergency fund, usually 3 to 6 months of living expenses, kept in an easy access account. Next, decide how much risk you can truly handle. A simple rule: if a 20% drop would keep you up at night, your portfolio is too aggressive. Spread risk by mixing broad market index funds with a few hand-picked stocks or ETFs. Limiting any single position to a small percentage of your total. Risk management isn't exciting, but it protects you from becoming a panic seller when markets dip. Mistake 3. Lack of patience and constant tinkering. This is perhaps the hardest for beginners, staying patient. Many people start investing with a solid plan, but then check prices every hour. When markets fall, they sell. When markets rise, they switch strategies to chase the next thing. The key insight: time in the market beats timing the market. Compounding, earning returns on top of returns, is slow at first, then powerful. The curve only bends upward if you stay invested. Warren Buffett once said his favorite holding period is forever. You don't have to hold forever, but you should let good investments breathe. A practical tip: automate contributions. Set a standing order each month, invest, and leave it alone unless your plan or goals change. Let's recap. Don't chase quick gains. Have a researched plan. Don't ignore risk. Keep a safety net and diversify. Don't lose patience. Let compounding work. Bonus tip: keep a simple investment journal. Write why you're buying each asset and under what conditions you'd sell. When markets get noisy, that note keeps you disciplined. If you learned something new today, give this video a like and subscribe to WealthWise for clear, practical guides on building wealth. Tell us in the comments which of these mistakes you've spotted or maybe made yourself, and how you're planning to improve.